Hello, and welcome to the Securities and Exchange Commission's Saving and Investing presentation for students. My name is Natalie Garner, and presenting with me today is Jonathan White. Before we begin, we are required to give this disclaimer before we speak to audiences. The SEC's Office of Investor Education and Advocacy is providing this information as a service to investors. This presentation is not a statement of official SEC policy, a legal interpretation, or investment advice. We are not providing legal advice or investment advice today. Instead, we're talking about general principles of sound investing and avoiding fraud. Here is what we'll cover today. We'll begin with a short overview of the SEC. Then we'll move to ways to save and invest and the risks involved. And finally, we'll discuss avoiding fraudsters. First, let's learn about the Securities and Exchange Commission. To do that, let's go back to your social studies lessons. You may remember that our founding fathers began with a constitution that set up 3 branches of government: the executive branch, the legislative branch, and the judicial branch. The executive branch includes many federal agencies with diverse missions, such as the Department of Treasury, Department of Education, and the Securities and Exchange Commission, which is an independent regulatory agency. Various agencies regulate the different stakeholders and institutions that play important roles in the economy, such as banks, the financial markets, and consumer financial services. Here are some examples of those agencies. The SEC was created in 1934 to restore confidence in the stock markets after one of the worst market troubles in the history of our country, the stock market crash of 1929. Stock markets are, so what are stock markets? Stock markets are, or capital markets, are markets for buying and selling financial products, like stocks and bonds. These financial products are also called securities. President Franklin Delano Roosevelt appointed the first commission of the SEC. Joseph Kennedy, father of John F. Kennedy, was appointed the first chairman. 5 commissioners are appointed to the commission by the president to serve staggered 5-year terms. Normally, there are 3 commissioners from the president's party and 2 from the other party. The SEC has 3 missions: to protect investors, to maintain fair and efficient markets, and to facilitate capital formation. Here are some of the ways we carry out the mission. We maintain fair and efficient markets. We impose fines on those who violate securities laws, or we bar them from the industry. We also require companies to disclose information, and we also educate investors. If a company wants to raise money for its business, it may sell its stock to the public. To offer its stock for sale, the company will generally file a registration statement with the SEC. A registration statement generally includes essential facts about the company, like the company's business operations, management, financial condition, and the securities being offered for sale.
Saving and investing. And why do we save? Do you want to own a home someday? Open a business? Start a family? Those are long-term saving goals. In addition to long-term plans, you also need an emergency fund to cover unexpected shocks like a major car repair, a house repair, or a health crisis. These things can require money in a hurry, and surveys have shown that many are unprepared to incur an unexpected expense. So put aside enough money for a few months worth of expenses just in case life throws you a curveball. Saving is all the money you earn but don't spend. Investing is slightly different. It means making that money grow. When you invest, you have a greater chance of losing your money than when you save. This is what generally is referred to as investment risk or just risk. For example, savings in a bank account are generally insured by the Federal Deposit Insurance Company or FDIC, but investments typically are not federally insured. So why would we put money at risk? You can't just stick money under the mattress because the money you have today won't have the same purchasing power for what you need tomorrow. Prices for goods and services go up over time. It's called inflation. Let's look at an illustration of inflation. The cost of a base model Ford F-150 pickup truck in 1993, and now 25 years later. A quarter of a century ago, you could get it for less than $12,000. But this year, the same model will run you more than $27,000, more than 100% increase in price. That's the result of inflation. And inflation also impacts higher education costs, housing costs, food and consumer goods, and everything we need to live. So to keep up with inflation, you have to make more of your money grow. And that's what we're here to talk about, investing. How do investments keep up with inflation? It's through growing over time with the power of compounding. Compound interest is the interest you earn on interest. Not only does the money in the account earn interest, but the previous interest itself earns interest, and then that interest earns interest, and so on, similar to a snowball effect. Thanks to the power of compounding interest, imagine that a 25-year-old, you made a one-time investment of $1,000 and did not touch the account again for 40 years. If you check the account again at 66 years old, your money would have grown to $14,974.46, assuming a 7% annual interest rate. By starting early and using the power of compounding, you're putting your money to work for you. How do investments keep up with inflation? It's through growing over time. Understanding compound interest demonstrates how your money can grow. That's when the money you invest earns interest. And then the interest you earn also earns interest. The rule of 72 shows us how quickly money can double depending on the interest rate earned, thanks to compounding interest. Just divide 72 by the interest rate you want to earn, and that will show you how quickly you will double your money. Here are some examples. And when you want to figure out how compounded interest will work for you, this is one of the most popular tools on our website, our compound interest calculator, which allows investors to see how their money will grow over time. It lets you plug in an initial investment amount plus the amount you plan to contribute periodically. Then you can plug in the interest rate you expect to earn. Investor.gov also has a savings goal calculator, which allows you to calculate how much money you need to contribute each month in order to arrive at a specific savings goal. This shows why you should take advantage of the power of compounding as early as possible. Let's say this is you on the left. You put $2,000 annually in your mutual fund for 10 years, starting at the age of 18 and continuing to 27. You never put another penny in after 27, but earned an average of 7% annually and retired at 65 with $337,774. Your friend on the right is also a great saver, but didn't start until the age of 31, putting the same amount, $2,000, into the same fund every year until retirement. Despite 34 years of diligence, your friend retired with $256,518, or nearly $81,000 less, because you had the power of compounding for a longer period of time. The takeaway lesson: start investing as early as possible. And here's another way to look at how compounding works for you and your friend. The blue portion is the amount of money that you put in from 18 to 27 and your friend put in from 31 to 64. The red part is the investment return as a result of compounding. Again, you can see that the returns on your investment are significantly higher than your friends, despite the fact that you invested less money. This is because you started early. The lesson: it pays to start early and putting compounding to work in helping to build your wealth. This is a critical point. Start investing for retirement as early as possible. As we've shown already, it's cheaper in the long run. For example, if your goal was to save $500,000 by the age of 65 and you started at age 25, you only have to contribute a little more than $200 per month over 40 years. If, however, you got a late start and began saving at the age of 50, you'd have to save more than $1,600 per month, nearly 8 times that amount, to get to $500,000 by the age of 65. Importantly, the blue shaded part of the graph is the interest your investments earn at 7% over the years. Starting early gets you way more interest. It helps to do your saving and investing automatically. In other words, set it and forget it. You can set it up with your bank to have money sent directly to an investment account. This creates the habit of saving and allows the power of compounding to work for you over time. This slide assumes a 7% average annual rate of return, and of course, stock markets can vary greatly year to year. If you work, you may be eligible to participate in an employer-sponsored retirement plan called a 401k that automatically deducts money from your paycheck and may reduce the taxes you are paying. Additionally, in many plans, the employer matches some or all of your contribution. When your employer does that, it's offering free money. Anytime you have automatic deductions made from your paycheck or bank account, you'll increase the chances of being able to stick to your plan and realize your goals.
Rule number 1 of investing is that all investments have risk. But if you are a long-term investor in the U.S. markets, you have historically done well. What stands out the most when you look at this chart? You'll see that there's lots of volatility. In other words, a lot of ups and downs. There are significant downs. The most prominent represent the 1921 stock market crash, the Great Depression banking panic, World War II, the oil shock, the dot-com crash, and the recent financial crisis or Great Recession. But you'll see on this chart that it's mostly up. The fact that the returns are mostly up shows the key message of this chart, that despite inevitable down periods, the long-term trend of the market is positive. Historically, the long-term average rate of return for the S&P 500 is between 8 and 10%. That means that long-term investors have historically done well. Therefore, if you have a long time horizon for your investments, you can capture the historical averages of the market by investing for the long term and ignoring the volatility and daily fluctuations. However, it is important to note that this also teaches that the shorter your time horizon on your investments, the more volatility becomes relevant. For example, if someone in 2006 planned to retire in the next few years but had all their investments in stocks, they would have been seriously hurt in the downturn in 2008 and likely would have been prevented from retiring at that time. As such, this teaches us that the nearer you get to your target date or your retirement, it is important to shift your asset allocations to reflect your changing risk tolerance. For example, you may consider increasingly shifting your portions of your portfolio away from stocks to less volatile asset classes such as bonds. The biggest difference between saving and investing is risk. So we need to figure out how much risk we're willing to take on. What's our risk tolerance? Different investments have different risks, and of course, the potential for greater return generally comes with higher risk. Look how we move from the safer but slower return cash at the bottom up to riskier but higher return stocks. Stocks are shares of ownership in a company. Stocks have historically offered the greatest potential return. A stock can appreciate in price and can pay dividends if the company distributes its earnings to stockholders. And investors willing to stick with stocks over long periods of time generally have been rewarded with strong positive returns. Stocks can lose value, however, and companies can even go bankrupt, leaving their stock worthless. Bonds are like IOUs. I lend money to a company or government body, and they promise to pay me back in a certain period of time. In the meantime, I can get a predictable income stream from the interest payments. The benefits of bonds are they provide a predictable income stream. Typically, bonds pay interest twice a year. If the bonds are held to maturity, bondholders get back the entire principal, so bonds are a way to preserve capital while investing. Bonds can help offset exposure to more volatile stock holdings, too. The risks include credit risk. The issuer may fail to timely make interest or principal payments and thus default on its bonds. There's also interest rate risk. Interest rate changes can affect a bond's value. If bonds are held to maturity, the investor will receive the face value plus interest. If sold before maturity, the bond may be worth more or less than the face value. There's also inflation risk. Inflation reduces purchasing power, which is a risk for investors receiving a fixed rate of interest payment. There's also call risk. There is a possibility that a bond issuer retires a bond before its maturity date, something an issuer might do if interest rates decline. The best way to manage investment risk is to allocate your assets and diversify your investments. In other words, put your money in different asset classes, and within the different asset classes, include different investments, so that if one investment performs poorly, another might do well. In short, don't put all of your eggs in one basket. Mutual funds and ETFs are a way to invest in the stock market without purchasing individual securities. Many workplace retirement plans, like 401ks, offer a selection of mutual fund investments to employees. The main benefits of mutual funds and ETFs are professional management. The fund managers do the research for you. They select the securities and monitor the performance. Another main benefit is diversification. Mutual funds typically invest in a range of companies and industries. This helps to lower your risk if one company fails. Affordability is another benefit. Most mutual funds set a relatively low dollar amount for initial investment and subsequent purchases. Finally, liquidity is a benefit too. Mutual fund investors can easily redeem their shares at any time for the current net asset value minus any redemption fees. Remember that all investments carry some level of risk, typically the same as the underlying securities. The way funds diversify is by holding many different stocks, bonds, or other securities. Diversification helps investors because if one company or sector experiences a decline in value, others may post gains. This graphic shows the S&P 500 stocks over a single day, and is merely an example of holdings that a hypothetical fund tracking the S&P 500 index might have. If industrial stocks in the lower right hand have a down day, perhaps gains in your tech stocks and financial stocks on the left side will insulate your overall portfolio. That's the theory of diversification. Here we have two types of funds you can invest in. Actively traded funds are funds that rely on the skill of an investment professional to buy and sell securities, often in an attempt to perform better than the market. Passive funds, like index funds, have a pre-designated basket of stocks, like the S&P 500 stocks or the Russell 2000 stocks, and they attempt to match the performance of a specific market index or benchmark rather than try to beat it. Actively traded funds may have higher fees, and if so, they need to have higher returns that make up for the higher fees.
When you're investing, you need to take steps to avoid scam artists who try to steal your money. To avoid being defrauded, you should check the license and registration status of any investment professional before giving them your hard-earned money. Investor.gov is our website for individual investors. Checking the background of your investment professional couldn't be simpler. Click the red button. That will bring you to our search screen, and it will allow you to put in the name of the individual or firm you are researching. Then you'll be able to determine if they're licensed and registered, if they have any disciplinary history, customer disputes, bankruptcies, or criminal charges. Plus, you can see their employment history. Now, what if we came across someone who's had a checkered history in the securities business? Did you ever see The Wolf on Wall Street? The character Leonardo DiCaprio played was a real-life person named Jordan Belfort. Let's plug him into the search engine. This is what you'll see. Jordan Belfort was barred from acting as a broker or an investment advisor or otherwise associated with firms that sell securities or provide investment advice to the public. Among other things, like his industry experience, exams taken, and employment history, etc. Would you want to know if someone's been barred by an industry before investing?
Let's talk about SEC resources now. Investor.gov is our website for individual investors. This is our Twitter page. We invite you to follow us there and join more than 60,000 followers who have an interest in investing and avoiding fraud. And we have a Facebook page. Feel free to like us. Do you have an audience that can benefit from our investor education message? Please contact us at outreach@sec.gov. Or you can contact us in the local office here in Chicago. Thank you for joining us today. We hope you've learned something and have garnered some information that you can use going further. Thank you.